Welcome back, Money Mondays. February 20th, Monday.
Really?
We're here on Money Mondays, ready to rock and roll.
You just checked it to see if that was actually the date. No, absolutely. Money Mondays, folks. We do this 3:30-ish Central Standard every Monday. We're talking about, what are we talking about today, actually?
We're talking about navigating your timing, your investments to maximize returns.
Oh my gosh, right? So it's not about just putting your thumb in the air and trying to figure out the best thing to buy and, you know, hey, it sounds like a great time to buy an apartment. There's also some strategy involved and some research that you should do, and, you know, ultimately timing this stuff and navigating through the different nuances in it. You can make a good deal bad, or you can make a bad deal good, folks, right? You know, so thanks for tuning in. Again, Money Mondays with your host, Ben Suttles, Ferris Musa, and we're going to get right into this. So we have some questions that kind of came in ahead of the show, right? We want this to be collaborative, so if you have questions, doesn't necessarily have to be about today's topic. We can go through that and drop them in the comments. Give us a like, give us a share. We want this to be a collaborative show, right? So
absolutely, we'll answer them here live. I'll take the easy ones. Ben will take the hard ones, and we'll keep rocking and rolling.
All right, you haven't done a ball joke in a while, dude. I'm surprised you haven't dropped that yet.
I was trying to be a little bit nice and wait at least 10 minutes before I gave the ball joke. Are you turning over a new leaf
this year? And then I feel like it's been all 2023. But all right, so what are some of the common mistakes that investors make when navigating and timing multifamily investments, right? How can those mistakes be avoided? I'd say not understanding, you can answer this a lot of different ways, it's pretty broad. The one thing that I'd probably say is you need to understand how macroeconomic things or events or trends could potentially, you know, affect the submarkets that you're buying deals in, right? You know, and I'll give you an example. This might be a stupid one because we don't invest out here. But let's say you're talking about San Francisco. Well, what's happening in San Francisco right now? Obviously, not only was it a completely overheated market, but it also had a lot of tech jobs. What's happening in the tech sector? There's a lot of layoffs, right? They essentially, you know, overhired people, and they're kind of trimming the fat, so to speak, right? You know, and so what's that going to do? You're going to have a lot of tech jobs that might move out of the Bay Area, right? If you're not keeping up with that, you're not going to know that, you know, that, oh, wow, this is happening. These are thousands of jobs that are going away in the area that I'm in, you know, and that's going to affect how your investment strategy should be rolled out, right? So I'd always say, look at what's happening in the market, the broader market, and how does that affect where you're investing in, right? And that's one of the reasons why we invest in the Sun Belt,
and
right?
Like we like to say a lot of times too, right? As an investor, part of your job is to make your job easier, right?
Yeah, absolutely.
You know, ride the wave where you can, and again, make sure you stick to the fundamentals, but at the same time, if you understand where the cycle is, you can give yourself more potential to succeed.
Yeah, no, I mean, I think, you know, one of the reasons that we invest in the Sun Belt is not because we live in Texas, and yes, of course we love Texas, but we would go invest everywhere else too if we needed to. It's not just because we love
for Topeka, Kansas.
Except
we
for
have
Topeka.
A disrupt equity core value. We will not invest in Topeka, Kansas.
Or Detroit, probably. No offense to anybody in Topeka or Detroit, because I think we've met some people there. From there.
I'm going to go look up where Topeka, Kansas is exactly right
you
now.
Know, but
Topeka,
the point is, we just happen to live in one of the hotter markets in the country, right? That's just by coincidence. But the reason that we continue to invest here in Texas...
Wait, you didn't decide to be born here and grow up here because of the market?
I mean, hey, I want to be in Texas, all right? But it's mainly the reason that we're investing here is because you have population growth, you have job growth, you have a business and tax-friendly and landlord-friendly state that incentivizes people like us to come in and invest in these types of projects, right? The wind is at our sails, not against us, right? You know, so that's an important point that people need to realize.
How many people do you think live in Topeka, Kansas?
I'm going to say 250,000.
125,000.
All right, well,
as typical, you're off by 100%. Damn. All right, keep going. I wasn't sure what to think. It looks like a lot smaller city whenever I look at a map, but
you know, and I'd say you can never time the market.
And so the population is growing, so the fundamentals may be good. Slightly growing.
How much is it?
Not as much as Lawrence, Kansas. Lawrence, Kansas apparently is
we've heard of Lawrence. I think that's around the Kansas City MSA. I think, but. Bottom line is, you know, to the flip side of this question, which is like, can you time the market? You can't time the market. You never can. People have asked us this the last 8 to 10 months. Is it a good time to buy real estate, right? It's always a good time to buy real estate, right? You can't time the market, folks. If you're sitting on cash and you think that you're the smartest investor in the room and that you're going to buy at the bottom, guess what? You're going to miss out on that opportunity. right? And you're going to miss out on opportunity. And we've seen people been on the sidelines since 2015 because they thought that stuff looked expensive in comparison to 2010.
Yeah.
And guess what? They just missed out on a fortune.
Remember, real estate, time in the market is better than timing the market.
Boom. I like that.
I thought of that one myself.
You did not. I've heard
Absolutely
that.
did.
You did not. Pretty sure.
I was just laying down one day on the hammock, and I was like, you know what?
Just pun, I'm going to come up with all these piffy, phrases. But I love it. And that's actually very, very true, right? All right, so what are some measures that you can take to structure investments for the best risk returns? I think we've talked about this on the show before, folks, right? Structuring your capital stack correctly is so very key right now, right? Whether that's the right debt, whether that's the right amount of reserves, whether that's, do you have a preferred return or not? Do you have pref equity or not? Right? And then what type of interest rate? All of these things and how you bundle them together in comparison to the deal that you're buying is so very, very key right now, right? It's no longer the hot part of the market where you can throw a dart at any deal and you're going to make money, right? You have to structure this properly. In some ways, it's kind of financial engineering, right? You have to put the right debt on the right deal, and you have to have the right reserves, and you have to execute on your business plan.
Not in some ways. All real estate investing is financial engineering. So if you don't understand real estate investing or numbers, you're not financial savvy. You need to get financial savvy. It is such a critical part of this business, period.
Yeah, absolutely, right? So, bottom line, structuring your capital stack, mitigating that risk, right, through having those capital reserves, right? Making sure that you can weather any kind of ups and downs in the market. If you've got, variable debt, right? A bridge loan, you have to buy a cap, or please buy a cap. We've seen too many people already that weren't buying caps on their bridge deals, and they got crushed. And those are going to be the people that are going to be selling at a loss, or potentially could end up losing the deal. We hate to see that. We do not want to see that. So please protect yourself by buying that interest rate cap. Again, look that up. We've talked about it's a hedge against your interest rates. It's a cap, right? So it only goes up to a certain point, and then above this, your interest rate cap kicks in and it pays off. It's like an insurance policy, right? Yep. You got to have that. So having reserves, having your interest rate cap in there, structuring the capital stack correctly, all of that's important. And then ultimately having the right insurance policy on here. These things happen. We own an insurance agency. We know that this is just what it is, right? Things are going to happen. And if you don't have the right insurance, or you're being peddled because insurance costs have been going up, we get that, right? But if you're underinsured, you're screwed. I'm telling you. And a lot of these insurance policies, it's like reading Greek. You just don't understand what they're saying. So you got to have the right people. We use Strategic Insurance Group over here in Texas. Great guys. They'll educate you on what you need to do, right? So moving on. What is the reason for calculating the short-term and long-term potential returns of multifamily investment? I think, again, you're determining...
You're giving yourself multiple outs, right? Hey, I can hold it for the short term. I'll be happy with it. I hold it for the long term. I'm happy with it, right? Because, again, real estate is about financial engineering, and you can't time it. So giving yourself multiple outs. It's like, the downhill slopes on those mountains where you have the truck, what's it called? Exit. Getaway truck things. You know what I'm talking about, right?
The lane that's off to the side. So
where if the truck brakes or busted.
The brake allows them to kind of go up the side of the hill or whatever. Have you ever seen that too?
Yeah, it's more so just to plow into something, destroy the truck, but keep the driver safe.
Yeah. So but I'd also say, right, it also allows you to, if you're looking at things from an IRR basis, right, which is really the time value of money, right? It allows you to determine, what deals you might want to potentially, it allows you to try to determine an apples to apples, right? You might have this deal. Now you have to look at risk adjusted, folks, so we'll take that out of the equation, but let's just say you have a 17% over here, 17% over there. You can kind of determine like, hey, if you're going to get 17% over 10 years or 17% over 1 year, what are you going to do, right?
Absolutely.
So you need to look at it from that time value of money, and IRRs are going to allow you to do that, right? All right, so moving along. When evaluating multifamily investments, how do you assess the potential for a successful exit strategy? I think, again, you can't time the market, and we're all about not being greedy either, right? So you can't what is it like hogs get fat, pigs get slaughtered, and so the whole
bulls
thing
make
is
money, bears make money, pigs get slaughtered.
Yeah, so the whole point is that the people are like, oh, I'm not quite there to 100% total return. I'm at 80%. But you're in year 3, folks. Take the 80% and run the other way, right? Take some chips off the table. It's so important to understand that in that next 2 years that you're trying to ride it out for that other 20% to get your double, get your 100%, your 2x multiple, that you could have a hurricane, you could have some natural disaster. Who knows? A World War III could break out, right? And then values just go through the freaking basement. So take the chips off the table, move it into the next deal, right? So that's where we're always keeping our ear to the ground. And what's the best time to refinance? What's the best time to sell, right? Where are cap rates at? How many buyers and sellers are in the market, right? There's certain markets that are more liquid and more active than other markets, right? Right now across the board, it's pretty slow.
Absolutely.
But I mean, I would say in the Sun Belt, you're going to have more transactions than say in another part of the market where there's not as many buyers and sellers. Right, Topeka, Kansas, probably one of them, right? So that's kind of, that's how you're going to be able to assess when it's a good time to kind of exit, right? And then last but not least, what factors should be taken into account when analyzing potential investment opportunities? Again, we've talked about this in the past, right? Do you have the rent growth? Do you have the population growth? Do you have the job growth? All of those things are key to being successful.
Make your job easier, folks.
Yes.
Don't feel like you have to make everything perfect, right? Or have to do all the work. I like when other people do my job for me, right? Especially if that thing is a market. So,
I mean, think about it like this, right? You throw yourself into a deal and it just hums, it just spits off money. And you're going to have some deals that are like that. We have several deals that are like that, where we don't really have to do much. We just bought them right, we put the right debt on them, and they're just incredible properties. Now, there's some that are a lot more challenging, and you got to work at them, right, to make those things hum. But at the end of the day, right? Do yourself a favor and buy in the right markets, right, where you're going to have that wind at your sails, And so we've talked about it ad nauseum on the show, the things that you should be looking at. That has not changed. It's not going to change, right? Again, real estate is all about, it's hyper local, but it's still about location, right? Boom. We got through that. Any questions?
I don't know. Comments, questions, thoughts, please go ahead and ask them. We'll answer them here live on Money Mondays. So, first one from our buddy Ronnie. Capitalizing deals well is a key to weathering storms.
Absolutely, man.
We've learned that one hard way.
We have, folks. Like, we give a lot of advice on the show, and it's not just us just like throwing out random factoids or
most of the stuff that
opinions.
he says is kind of random stuff, but the stuff that I share is usually
it's born out of the fact that we've been through it, folks.
There's value to experience.
Yes, and so we're trying to educate you guys so you guys don't go through the same challenges that we have, right? We didn't have a Money Monday show to look at, right? We just kind of went out and just started doing it, and we've learned a lot of things the hard way from, especially on the debt side. We've probably had every lender challenge, including right now that I'm going through on our last deal, that you could ever imagine. And I try to button it up as much as I can, and the lenders are always going to be the wild card on any deal that you do. So all the more reason to buy right, because sometimes if they see a good deal too, just like you do.
Absolutely.
Right? They make it a little bit easier to get through it.
So let's keep going. Ronnie says structuring the debt properly is important when buying a deal and analyzing the exit. Step down versus yield maintenance versus bridge debt. Explore all options.
No, I think actually that's a good point. Let's talk about prepayment
penalties. The debt
penalties.
is important, but then also risk is important. So those two things kind of, there's a little bit of a balancing act. And again, we've had deals that we fortunately paid $1 million penalties to sell early, right? Still made strong exits. That's obviously why we did it. But in hindsight, it would have been easier to have done a different debt structure. But in hindsight, life is a lot easier, right? The flip side is the market could have happened like what it is now. And now everybody with fixed rate debt is pretty happy that fixed rate debt. So it's a balancing act. There's not a right or wrong necessarily, but again, understanding where you are in the cycle will help you more likely make the right decision.
So let me give you guys some examples of what we're talking about here. So, back in the day, everybody did Fannie and Freddie fixed rate debt, right? And because of that, everybody had prepayment penalties, which are penalties that you get from the lender if you sell your property before the term is up, right? And it's either yield maintenance or defeasance, and they're both overly complicated. Look them up. There's even websites, Defease with Ease, that you can calculate them on, but it's expensive. Right? Because what's happening with these loans is they're bundling all these up and they're selling them as a bond, right? So if you sell the bond, well, what's the bondholder going to do? Now they're holding this thing that's worthless. So they're going to say, no, I want all that interest paid to me based on where interest rates were then versus now, right? And so what he's saying now is that everybody that locked in 3, 4, 5 years ago is in the money because interest rates went up, and therefore prepayment penalties went down, right? And so you need to understand that. Step down is a whole nother thing too, right? It's 5.5, 4.4, all these different things that you can do to creatively get out of these loans, but they're always a penalty, right? All the way down to you can be on par and you don't have a penalty at all. But you have to judge the risk and what kind of business plan do you have, right? Are you planning on holding it for 2 years and then wanting to sell? If so, I wouldn't put Fannie Mae and Freddie Mac debt on it because that's more meant for a longer term hold, right? And so that's a good point, Ronnie.
Absolutely.
Yeah.
So let's see if you have any more comments, questions, thoughts. Please ask them. Another one from Amanda. What should passive investors be looking for given the uncertain market conditions? I would say debt structuring, like we just talked about.
Yeah.
That's an important one, right? Again, for an investor, not every deal is the right deal. Make sure it aligns with your long-term goals.
Yep.
So I think debt structure is a big one. And again, even understanding market conditions, right, within that market. Is it an overheated market that's softening, maybe like a Phoenix? Or is it, a market that's kind of boring
Phoenix
and
got
stable?
asked from our list too. So, and the reason that we're not going to be looking in Phoenix is because we do feel like it's overheated, right? Not to say that it's not a good market, but for what we do, it's not great, right? And so I'd say definitely debt structure right now. I mean, we're paying 8% plus on some of our deals right now. We have an interest rate cap and it pays handsomely, but the actual overall interest rate is high. Right, so if you can lock in at a fixed rate debt and sub 6, call it 5.5, that's pretty good, right? And so I'd say that mitigates a lot of people's fear and risk of inflation and interest rates spiking, when you're looking at this stuff. But really, the ultimate hedge and risk, risk mitigation, really on all these is the submarket that you're in. Buy in good submarkets. Yep. If you buy in the right ones in the Sun Belt and some of these other markets, you're going to be all right. Because long term, the statistics are behind us, right? The population growth is going to continue to rise. Jobs are going to be there. Rents are going up. That is just the fundamental facts of the deal, right? And you have economist after economist saying the same thing. Whereas New York and California might still be all right in certain pockets, but people are leaving those places, right? So do you really want to be on a falling sword? I'd say not. Right? So I'd say if I'm an investor, if I'm a passive investor, I'm looking at the right debt structure and I'm making sure that these are in the right markets that I want to be to long term.
Completely agree. Let's keep going then. I think that's about it. If any more comments, questions, thoughts,
Boom.
Please ask them. We'll answer them live. Otherwise, let's keep churning along.
All right. Boom. MFIN.
Our cheapest price. We just had it last week. It was a home run. 750 people, somewhere around that range.
Yeah.
Huge success. So we're looking to do it again on the West Coast.
Where are we doing it?
I'm asking you the question, Ben. We're going to San Francisco.
Oh, going to San Francisco. Wow, literally, I didn't even think about that. I was just using that as an example earlier.
Using what, to San Francisco?
Yeah. So we are. Maybe it was on the top of my mind.
So we're definitely excited. It's going to be a fun time. Get out there. Nice time of the year to be in San Francisco.
When are we doing it?
August 4th.
5th. Right?
5th. Whatever that Saturday is.
5th. See, I was right.
The 5th?
I'm getting the 5th
Whatever that Saturday is.
Because
I'm mixing up the next one after that, which is in November, but we won't announce that one yet.
So go check it out, folks. We'll probably have 500 people out there. It's going to be a great show. We're going to have Mr. Neil Bawa out there as well. But it's going to be fun. So check it out. $200 off when you pre-register.
Prices will go up every week upon the week.
February 24th. That's actually coming up. That's a couple days.
Man.
So this is going to be your best price, folks. It's going to continue to go up from here, right? So check it out. www.mfinvestornetwork.com/SanBran to get your best prices on that. See you August 5th. But before we get to that, we got another meetup.
We got another meetup coming up.
Oh my
March
gosh.
2nd, Thursday, first Thursday of every month. We're talking about developing your brand in real estate. And it's going to be yours truly as a presenter. So lots to talk about. We know we've done a thing or two about it and lots of things to consider. So would love to see you there if you're here in Texas.
Wakefield Crowbar. It's in the Heights, right?
Yeah.
Garden Oaks, I guess.
I don't know what to call that. A Garden Oaks. I could call it Northern Heights.
New Heights, maybe? I don't know.
Northern
But check it out.
Heights.
DisruptEquity.com/HTX meetup. We typically get 75 to 125 people out there. It's a great time. We're not selling you anything. We're just talking shop.
Independence Heights.
Independent Heights.
Is the right
Boom.
name.
See, we're close.
You're close.
We're close. So check it out. Meetup coming up March 2nd. But what are we talking about next week?
Self-management versus third-party management.
Something that we know a little bit about, right?
For whether you love it or hate it. So
yeah, management is where the rubber meets the road, folks. So check that out. It's going to be a good show. We'll have a lot of content on that. But we will see you then on the next Money Mondays.
All right. Thank you very much.